Now, the middle of summer and the trading is light, or is it? What about trading that takes place off of exchanges? Has that been affected by the summer doldrums? Well, let's bring in Seth Merrin. He is the CEO of Liquidnet. Seth, it's good to have you with us. Thanks very much for coming in.
Absolutely.
First of all, in fact, one of the sort of catalysts for talking about volume is this whole notion that, volume has basically dried up. We don't see a lot of it. But volume takes place in a lot of different places, right? Because it's not just trading on exchanges. Liquidnet is about trading off of the exchange.
That's correct. And there are multiple venues today. 10 years ago, the exchanges pretty much had a monopolistic position on liquidity. And over the last 10 years, liquidity has gone away from the exchanges into other venues, whether it's ECNs or it's dark pools, and into being traded by new types of constituents like high-frequency traders today.
All right. Now, you talked about, you mentioned the words dark pools. And just to explain, if you can, what exactly are dark pools of trading?
The exchange is a displayed market, so you see the quotes. And dark pools are non-displayed. And they provide a new way of trading for a different type of constituency. The institutions, for instance, have such large orders. They could have a 250,000 share order. And when they go down to the exchanges or the ECNs, the average execution size is about 300 shares. And that's just a mismatch. And you cannot imagine that an institution would put 250,000 shares on the bid side against 300 shares on the offer side, because we know where the stock price would go. So dark pools or non-displayed pools were created to accommodate institutional trading different from the needs of the retail trading, which the exchanges are great at.
All right. So the idea being that if you want to trade these huge blocks, as this example offers, the idea would be that you get to enjoy anonymity. You get to place this trade, execute the trade off the exchange using these dark pools of liquidity, matching it against someone who wants to take the other side. Does that eventual trade get reported somewhere? Does that get sort of factored into the consolidated price?
Yes, and that's what's great about the market structure in the United States, different from in Europe, let's say. But yes, every trade has to be reported to a reporting facility within 90 seconds, and that gets consolidated up into the pricing tape. So yes, all trades are represented within the pricing tape.
Because it seems as though whether you're a buyer or a seller, if you're using a dark pool of liquidity, if you're using a Liquidnet, you want to make sure you got the best price.
Absolutely. And all the prices today are within the confines of the exchanges. So the exchanges are still setting pricing today. And in fact, there's more volume going on the exchanges today because there are new constituents coming into trade. So the institutions are piggybacking on the pricing mechanism, which is fine, and everything is done generally within the confines of the bid and the offer on the exchanges. So it's simply providing another venue, a different venue that handles a different type of trading. One size will not fit all. One trading venue will not fit all constituents.
And what are you seeing now in total trading volume? Have you seen a big decrease?
The institutional trading certainly has tailed off tremendously. And it's a reflection of what's going on in the market and the economy today. So there was a huge run-up, as we know, in a very short period of time. And lots of institutions actually caught it well. And they are done for the year. They might be up 20%, 30%, and they want to go home. And then there are the others that simply did not catch it. And at these levels, they're concerned about diving in right now. Everybody seems to be waiting for more economic news to at least give some direction, whether it's up or down, so that they know what to do.
So are you seeing a different constituency come in and trade more actively? Are you seeing different types of traders?
Absolutely. In fact, over the last couple of years, there's a whole new constituent that's come in that is now dwarfing all the other constituents combined. It used to be retail trading, institutional trading, and market-making trading. And that was what made up the trading on the exchanges. Today, 2/3 of the trading are none of those. 2/3 of the trading are high-frequency trading.
And what is that doing to market volatility?
Well, it's tough to say, but there are reports that say that the high-frequency trading exacerbates the volatility. But it's really tough to pinpoint. High-frequency trading can be broken down into different types of trading itself. But it's a whole new constituent that's, in fact, adding liquidity to the market today.
Because they're being more active in the market.
They are.
All right, I want to thank you very much, Seth Merrin, the CEO of Liquidnet, coming in and giving us some details about the world of trading, volume, as well as dark pools of liquidity. Thanks very much for sharing your insight.